Hello and welcome to the Look Forward podcast, powered by the S&P Global Institute, the platform for enterprise thought leadership across S&P Global. I'm Molly Mintz, lead strategist at S&P Global Ratings, and I'll be your host today. Markets are moving faster, risks are shifting, and decision makers need foresight. In this podcast, we bring you expert perspectives from across S&P Global on the macroeconomic, market, energy, and technology forces shaping what comes next, helping you navigate uncertainty and look forward with confidence. Recent investor redemptions and the potential for AI disruption have put private credit under fresh scrutiny. As private markets expand and new capital enters the financing ecosystem, greater scale and growing interconnections with public markets have raised questions about whether systemic risks could emerge. On this episode of the Look Forward podcast, powered by the S&P Global Institute, I'm joined by two colleagues from S&P Global Ratings. Matthew Mitchell, Managing Director for Structured Finance, and Evan Gunter, Managing Director and Head of Private Markets Research. Today, we're delving into their recent insights on the pressure points to watch in the market for potential systemic risk from private credit. Matt, Evan, thanks so much for joining the podcast today.
Thanks, Molly. Great to be here.
Molly, thanks for hosting us. So good to see you again.
My first question is about the rise of private credit. So the rise of private credit has added to the dynamic nature and the depth of capital markets and provided additional sources of financing to borrowers, evolving over the past 2 decades of banking disintermediation into an advanced ecosystem of alternative asset managers and the investment vehicles that they manage. Now we've seen private credit recently experience a shift in perception from being an enviable asset class to enduring heightened scrutiny. Matt, I'm looking to you to start and set the stage. How did we get here, and what is driving this current state of play?
Sure. So, the initial growth phase of private credit really followed the global financial crisis, where banks significantly curtailed their lending, leaving a gap for many mid market borrowers. And that's where private credit lenders really stepped in to fill that void. So, they stepped in via direct lending. The market has since really experienced dramatic growth. Right now, in the direct lending space, some participants estimate that it's at about $2 trillion. So, really mirroring that now of the broadly syndicated loan space. And naturally, as markets grow in scale and sophistication, there's going to be increased concern about their potential influence on the broader financial system. We're also seeing a changing landscape, though, with respect to the originations now of many private credit lenders. So some of the initial draw was to direct lending and the yield pickup that you could get. But now, with more competition, we've seen spread compression in that space and a look for managers to really diversify and grow and diversify their AUM into other sectors. And I think one of the fastest growing segments has been in the asset based finance space, where the collateral as well as deal structure can provide significant protection to lenders. And when I talk about asset based finance, it's really a very, very diverse sector. It can include things such as equipment finance. So think airlines, think shipping. You can think of royalty streams such as music rights, residential and commercial real estate. And really recently, gathering all the headlines is digital infrastructure. And it's not just the data centers themselves, but also their power supplies, the equipment in the racks, cooling, and GPU leases as well. Really taking off within probably the past 12 to 24 months in the private credit space and the types of queries that we're getting. Now, I've touched on half the growth story, looking at the assets. The other half of the equation, though, needs to be where is this capital coming from? And we do see a mix of institutional investors, sovereign wealth funds, pension funds, some high net worth individuals, and other retail money. But one of the key growth drivers here has been insurance companies and just the amount of capital that's been flowing into retirement annuities. This has resulted in innovative fundraising structures by these funds and by the private credit managers. Examples like rated note feeders, collateralized fund obligations, and the fund structures as well now evolving to match the amortization profile of these longer dated liabilities.
Matt, thank you. That's a perfect transition to take a closer look at what's happening with business development companies, a different investment vehicle that are really capturing market attention right now. Evan, this is a question for you. S&P Global rates over 15 BDCs with total assets of approximately $325 billion at the end of last year, providing us with visibility into BDCs that cover around 55% of total BDC AUM. Given this breadth of perspective, what is S&P Global Ratings' view of these investment vehicles' credit and redemption risks at this time?
Molly, thanks for having us here. This is a good question, and it's one that is being asked frequently throughout the market. With AI advancement, what kind of potential disruption does that have for the software sector? And i- if related to that, what kind of impact does it have on BDCs? We don't believe that the credit impact or the redemption risk impact is a near-term risk for those software companies or for the BDCs. Uh, Among software companies for which we have a credit opinion through our credit estimates, so these are uh, companies whose loans are held by mid-market CLOs. We see recent credit quality has shown resilience. There's been more upgrades than downgrades of credit estimates, and the default rate has been coming down over the last year. Within this strong performance, software is one of the strongest performing sectors within credit estimates. When we think about the potential impact of AI and AI disruption, we don't expect this to be uniform. We expect the impact to be more differentiated. You can kind of think about that as there's going to be some winners and some losers. Those with a wider moat, those companies we would expect to be more resilient are likely those that have proprietary data, embedded customer relationships, or ones that offer more mission critical products. And on the other side, those that are more vulnerable to the potential for AI disruption are those that likely have more narrow moats. And but also the credit risk for these is not immediate. It's more of an eventual impact to the enterprise valuations. And this could add to the refinancing challenges down the line, such as in 2028, when maturities rise. Those 2028 maturities are there was a lot of debt that was issued right after COVID, much of which is coming due in 2028. Even though we expect the impact of AI disruption will be differentiated, investors took a more sell first, ask questions later approach earlier this year. In broadly syndicated loans, we saw software prices drop from about 94 in January down to below 88 by March. And those prices really haven't recovered yet. Meanwhile, the publicly traded BDCs are trading at near 20, we're trading at near 20% discounts. But the non-traded BDCs did not have such a discount. They weren't marked down, and we saw a surge of redemption requests coming from investors. Now, typically, a non-traded BDC limits redemptions to 5% of its net asset value. This is a way for them to protect the existing investors and prevent forced selling. Where the non-traded BDCs limited their outflows to 5%, they were functioning as they were intended, but the headlines of funds limiting redemptions added to investor concerns. So, our rating analysts who cover the BDC sector recently did a stress test. It was a very it was a pretty harsh assumption in their stress test where they were assuming no inflows for the perpetual non-traded BDCs and no level two asset sales. And the stress test was to see how is their liquidity if they're facing continued elevated redemptions. So in the stress test, even with no inflows The rated perpetual non traded BDCs showed sufficient liquidity to withstand 4 quarters or more of these elevated outflows. The software sector is facing potential disruption from AI, and this is adding to the pressure on BDCs. But we don't view either of these cases, the potential disruption for AI or the potential uh, for elevated redemptions, uh, to be a near term risk. Credit quality in software is holding up, as is the liquidity among the rated BDCs.
So, from a macro credit perspective, given the rapid change in this market and its recent challenges, S&P Global Ratings' latest credit conditions research noted that rising stress in private credit is a top risk to watch due to its potential to impair liquidity, erode investor confidence, and add to market volatility, primarily in North America, but with a possible spillover to other regions. Bringing both of you into the conversation now, what are the pressure points in private credit that could potentially have systemic implications?
So, Matt and I worked together on a research report earlier this year that looked at pressure points in private credit. And one of the things that we were looking at is that the private credit market is changing as it's growing. And some of these changes could put more pressure on the system. First of all, a pressure point is liquidity. Private credit assets are by and large going to be illiquid, buy and hold assets. A fund manager must match the timing of their liabilities against this largely illiquid asset. For a fund structure with locked in capital, it's easier to plan for the timing of liabilities, but a semi liquid fund structure, such as those non traded BDCs or interval funds, it's harder to predict when the investor will demand a return of capital. But as the market's been changing, semi liquid funds have seen the most growth in recent years. 5 years ago, publicly traded vehicles counted for the majority of BDCs, but now they've been far surpassed by the non traded BDCs. So, this rise of semi liquid vehicles adds one potential pressure point. Another potential pressure point is the complexity. Private credit is not just mid market corporate direct lending anymore. As Matt was mentioning, there's lending that's going to large corporates, digital infrastructure, as well as vehicles such as asset based finance and SRTs. It's a market that's growing in diversity and complexity. One sign of this is among recent fund launches, specialty finance is gaining as a strategy with more new fund launches, growing as a share relative to direct lending. Another potential pressure point is the interconnections. As the market is growing, we're also seeing it's increasingly connected to banks and insurers, which are some of the more systemically important players in the market. Among banks, non bank financial institution lending has been their fastest growth area. And among insurers, private credit has been a growth area for their asset holdings, especially for life insurers. Where in life insurers, we estimate that about 10% of North American life insurers have bond holdings that are privately rated and privately placed. Another area is concentration is a potential pressure point. What we've seen with the investor concerns for software is a good reminder about the importance of diversification. BDCs show a concentration in software that accounts for about 20% of their loan assets, and mid market CLOs have about a 16% concentration. Diversification is a key pillar of risk management, and so we'd expect that rising concentration in non diversified risks would further add to the pressure within the system.
And maybe I'll dive in with some specific examples, speaking to what Evans talked about with respect to the complexity and interconnectedness aspect. So, on the complexity side of things, as I mentioned at the start, and as Evans alluded to, we have seen kind of material growth within the digital infrastructure and asset based finance or ABF space. This can add complexity relative to direct lending because it requires an assessment of risk related to construction, technology, some esoteric assets, alongside additional legal and structural mechanics and increased operational risks. Furthermore, with some of the new debt structures that we're seeing now, so I mentioned, you know, rated note feeders, collateralized fund obligations at the fund level, looking down to the underlying asset level, you've got different combinations of back leverage, structured equity, uh, and these can really increase the structural and contractual complexities that are at play. On the interconnectedness side of things, the common one that comes up right now is significant risk transfers or SRTs. This is getting a lot of attention by regulators, in particular, given the relatively small number of private credit funds that comprise some of the largest investors in this market. Some of the risks that have been identified here include potential hidden leverage in the financial system. And what that's speaking to is if banks are providing funding, so fund finance facilities, repo facilities to these lenders, have you actually truly transferred the risk of those portfolios outside of the financial system? And also, just from a capital perspective, banks' reliance on these private capital providers, uh, given that it's not a permanent source of capital for these banks. Banks need to be conscious of the ability to go out and issue new SRTs to continue their originations, and just from a capital perspective. But we have seen mitigants to these risks. For instance, for banks, they typically are staggering their maturity profiles such that there's not kind of a refinancing wave that's needed to really mitigate that potential capital impact if for whatever reason they can't access the SRT markets and these private capital lenders aren't available.
But notably, these pressure points haven't imploded. Your view is that current stresses in private credit are unlikely to pose a risk that would materially disrupt the financial system or the broader economy. So, my bigger question is, what would it take for systemic risk to materialize in private credit?
Thanks, Molly. So, as you're kind of mentioning there in your question, a systemic risk is one where the risk of disruption in financial services has serious negative consequences for the real economy. We get the question, does private credit pose a systemic risk? And when we started thinking about it, uh, we came to the approach that systemic risk is not a singular risk. It consists of three separate components. The first component is system wide risk. So, what are some of the risks that are si- across the entire system? In this case, we're looking at some of those things that are inherent to private credit, including the limited liquidity, the limits to transparency, and also, as Matt was describing, kind of like a new system wide risk that's sort of on the rise is this rising complexity, especially as the market is extending to asset based finance, digital infrastructure, and SRTs. The second component is the contagion risk. How could the failure of one entity pose risks to another in the system? Some of the factors that can heighten contagion risk include the interconnection. So, like Matt was describing, banks funding and the transfer of risks within the private credit system. These dependencies across institutions for funding or the shared exposures is one potential factor that can affect contagion. Another factor for contagion to look at is leverage. Leverage amplifies risk, and as you have new vehicles in the market, can add new leverage or new layers of leverage. Uh, Separately, always with contagion risk, there's concentrations. Are there concentrations of non diversified risks that are pooling within the system? That's one of the factors to consider for whether there's contagion risk within a system. Third component is systemic importance. How critical is the entity to the system itself? For an institution, there's the risk that a failure or loss of a specific party, like for instance, a bank, an insurer, or an investor, could trigger a loss of economic value or confidence in the broader financial system. So when we look at these exposures, we think, okay, is this exposure held by an entity that's systemically important? And then the other key systemic importance is what is the exposure level? So it's not just is this party holding a risky asset, but how exposed are they to a risky asset? And is the size of the investment, uh, particularly as held by a systemically important institution, is that exposure large enough that a loss would be material? So, taken together, this system wide risk, contagion risk, and systemic importance are the factors to evaluate and to determine if private credit poses a systemic risk.
And maybe jumping further into Evan's comments on concentration. So, with increased concentration, has the potential for increased correlation of performance as well. That's not only necessarily default risk, but also market value risk. A lot of the financing structures that we've seen in place aren't necessarily just credit dependent, but they could have triggers related to the actual mark to market values. Uh, and if pricing models were to change, we question whether that potentially means an impact across any asset, in particular those level three assets that may be hard to value that are illiquid in the private credit space. Uh, and also the other thing that we think about is not just default risk, but in going back to the earlier comments of, well, where is the capital coming from that's fueled this growth in private credit? It's from prudentially regulated institutions, so primarily insurance companies. And so it's not just about default, but what is the capital impact upon downgrade? And so thinking about credit stability is also a big part of what we've been doing, and some of the sensitivity and stability tests and commentaries that Evans already discussed look at what would the capital impact be if you were to have widespread credit stress within these private credit portfolios. And right now, we do believe that there is a sufficient capital buffer that we wouldn't be expecting a material ratings impact, even under a fairly conservative stress scenario.
Now we're going to bring out our crystal ball. It wouldn't be the Look Forward podcast if we didn't look ahead. The interplay between public and private markets, the potential risks that could arise from the rapid growth and interconnectedness of these markets, and the complexity of exposure between traditional financial market institutions and private market players, all of these are clearly intensifying. So, looking forward, how do you both anticipate that this nexus will evolve, and likewise the potential for systemic risk over time?
Thanks, Molly. So, when I look into my crystal ball for the future of markets, one thing that it's clearly pointing to is that this private market, private credit in particular, is a market that's growing and it's evolving, and the investor base for it is expanding. While liquidity and transparency are key features of the private credit market, with this expanding investor base, there are new investors coming into the market that are putting new demands for liquidity, new demands for more sources of transparency. Like Matt was just mentioning, looking into where the capital is coming from and more insurers coming into this market. That's creating new demands out there for liquidity as well as for transparency and reporting. For liquidity, there's new fund structures. I mentioned the growth of semi-liquid structures. Also, there's initiatives to start secondary market for trading of private credit assets. So it'll be another source of liquidity at the asset level. There's also the growth of credit secondaries as LPs that have been holding on to funds in a slowing exit environment, or GPs looking for ways to unlock liquidity. For transparency, the stress that private credit has come under so far this year is adding to more demand from investors and regulators for more standardized information on asset quality and performance. In an opaque market, a question on confidence from investors can spread quickly. Already, we're starting to see signs of enhanced and more standardized reporting coming to market. Like, for instance, we've seen US banks have started providing more disclosures on private credit and private equity exposures. Insurers are updating how they classify private assets with guidance from the NAIC. And LPs are increasingly looking for more standardized reporting of performance and assets that are included from the GPs. As the market matures, I expect investors will likely coalesce around new standardizations for tracking and for the reporting and analyzing of private credit.
from my perspective, where we've seen a lot of the headlines related to private credit today are in the direct lending space. And naturally, we do view those as riskier credits. Those are typically in the single B to triple C rating category, where we believe that the likelihood of default is a material risk. Where we've seen this shift in capital flows within private markets is more now into the asset-based finance space or multi-credit strategy funds. And a lot of the times these are being structured, and I'm probably biased because I have this structured finance background, but these investments are being structured to an investment grade rating level. So you're seeing a fundamental shift in the risk profile that's being taken uh, to really more stable, predictable cash flows that are matching that of who ultimately the end LPs are now in these vehicles.
Matt, Evan, I certainly learned so much from this conversation. Thank you both so much for joining the podcast and sharing your insights.
Thanks, Molly.
Thanks for having us, Molly.
To our listeners, thank you for listening to the Look Forward podcast, powered by the S&P Global Institute. To access the research and insights discussed, please visit spglobal.com/ratings/private markets. And to learn more about the S&P Global Institute, please visit spglobal.com. I'm your host, Molly Mintz, and I'm looking forward to accelerating essential intelligence together next time.